As we reflect on the second quarter of 2025, the early April market dip already feels distant, when the United States introduced a broad-based 10% tariff on global imports, among other protectionist measures. This development triggered a sharp correction in U.S. equity markets in a period that many termed peak uncertainty. Periods of heightened uncertainty can paralyze economic decision-making, especially for businesses and investors. However, markets soon regained their footing. A series of de-escalation steps related to tariffs, some bilateral agreements, and government policies helped restore market confidence through May and June. Despite easing trade tensions, we're witnessing a notable shift in global investment flows. Investors are gradually diversifying away from U.S. assets and growing concerns over the trade and long-term fiscal sustainability. The U.S. dollar index has declined by more than 10% year-to-date, reflecting these evolving perceptions. This raises a question many clients have been asking. Why have capital markets remained so resilient in the face of trade and uncertainty? We believe two key factors are helping support the current environment. One, corporate earnings are growing. Facing an uncertain environment, companies have been more conservative in their capital deployment and hiring, which in turn have increased margins as revenues were not as affected as initially thought. According to FactSet, S&P 500 earnings are expected to grow by 9% in 2025 and 14% in 2026. Since markets are forward-looking, these future growth prospects have therefore helped support the current rebound in equity markets. Second, monetary conditions are loosening. We're witnessing a renewed expansion of global liquidity. The global money supply, which aggregates cash plus assets that are almost as liquid, has been growing significantly in 2025. Large government deficits in developed economies are contributing to the rise in the money supply. And a portion of this liquidity is inevitably going to find its way into equity markets, providing an underlying tailwind to risk assets. There's also the expectation that more stimulus will find its way into the markets in the form of government spending and lower interest rates. For equities, the quarter was eventful, but it demonstrated the operational strength of the majority of our holdings, and we're able to take advantage of lower pricing when it did present itself. We actively rebalance our positions each quarter in line with our investment process. Our fixed income exposure was stable. However, we've reduced our allocation to long-duration bonds as we view persistent fiscal deficits as a potential headwind for long-term interest rates. As for our alternative investment basket, we've improved the liquidity profile of the portfolio, gradually reducing private market allocations. The April correction presented an attractive opportunity to reinvest the proceeds into income-generating assets in the public market. While market conditions remain dynamic, we're comfortable with how our portfolios are performing in this kind of environment. We continue to monitor both economic conditions and our individual holdings with diligence and care. On behalf of the TWM Group, thank you for your continued trust. See you next time.